Liquidity risk is a factor that is easily overlooked by investors. Naturally, investors tend to focus on factors likely to influence asset prices directly: economic growth, inflation, interest rates, and corporate earnings. Yet, liquidity, while less discussed, is an important force shaping financial markets. It influences how assets are priced, how quickly markets recover from shocks, and ultimately how easily investors can buy or sell investments when they need to. Indeed, many financial crises are based on liquidity crises. Once liquidity disappears, even high-quality assets see rapid price falls. Therefore, understanding liquidity is central to understanding capital markets. A highly liquid asset. Shares in large multinational companies, major government bonds, and leading currencies such as the US dollar has a large number of buyers and sellers actively trading in the market. Liquidity means that transactions can be completed quickly, at relatively low cost, and with minimal impact on market prices. Less liquid assets may trade infrequently, have relatively few potential buyers, or require investors to accept a substantial discount to complete a sale. Among these are commercial property, infrastructure investments, private equity holdings, and many smaller company shares. Liquidity is therefore not simply about whether an asset can be sold. Almost any asset can eventually be sold at the right price. Rather, liquidity reflects how easily the asset can be converted into cash while preserving its value. Liquidity is a term often used broadly, but in fact encompasses two interrelated concepts. Market liquidity refers to the ability to trade securities without causing large price movements. Deep markets with many participants generally exhibit strong market liquidity. Funding liquidity refers to the availability of cash or financing. Banks, investment funds, and financial institutions rely on funding liquidity to meet payment obligations, finance trading positions, and satisfy customer withdrawals. The two are closely connected. If funding becomes scarce, investors may be forced to sell assets quickly. Where there are insufficient available buyers, market liquidity reduces and prices to fall further. Depressed prices may then create additional funding pressures, reinforcing the cycle. Liquidity is a prerequisite for efficient capital markets, and it performs several functions. Price discovery. Where there are many buyers and sellers continuously trading, market prices tend to reflect available information more accurately. Transaction costs. Narrow bid-offer spreads allow investors to enter and exit positions more efficiently at lower cost, improving overall market efficiency. Investor confidence. Investors are generally more willing to commit capital when they have confidence they can access it again if circumstances change. Economic growth. Companies and governments can raise capital more efficiently. Once liquidity disappears, however, the effects can spread rapidly across financial markets. This was notably the case in the global financial crisis of 2008, when markets for mortgage-backed securities and other structured products effectively froze as confidence collapsed. Institutions holding these assets found that they could no longer sell them except at heavily discounted prices. During such periods of market stress, central bank intervention is crucial to support liquidity. By acting as lenders of last resort, they can provide short-term funding to banks and other financial institutions experiencing temporary liquidity shortages. During major crises, central banks may also purchase government bonds or other financial assets, injecting liquidity directly into financial markets through programs such as quantitative easing. Liquidity risk tends to emerge precisely when investors most need access to their capital. 2 examples. An investment fund offering daily redemptions may hold assets that cannot easily be sold within a single day. In the face of heavy withdrawals, fund managers may be forced to sell their most liquid holdings first, potentially leaving remaining investors with an increasingly illiquid portfolio. Investors using borrowed money may be forced to liquidate assets quickly if lenders demand additional collateral, creating further downward pressure on prices. Perhaps the most topical concern over market liquidity relates to the rapid growth of exchange-traded funds, ETFs. Many ETFs provide investors with highly liquid access to asset classes that are themselves relatively illiquid, such as corporate bonds, bank loans, or emerging market debt. Under normal conditions, the ETF structure has generally proved resilient. Market makers and authorized participants help keep ETF prices closely aligned with the value of their underlying assets. However, during periods of market stress, price differences can emerge between ETFs and the securities they hold, reflecting changing market conditions and temporary reductions in liquidity. The lesson for investors and portfolio managers is while liquidity risk may be relatively less visible than other risk factors, it should never be discounted or underestimated.